Hey guys, what is going on? Welcome back to my Robinhood portfolio. Today I thought I would talk about averaging down. This comes in response to a viewer comment, Gordon LZ, on a video about a month ago, asking, can you talk about what it means to average down? So I thought I'd just quickly go through what averaging down means. Very simple to understand strategy. Very easy to employ, but you got to be very selective on using this strategy. You can lose a lot of money if this is done on an incorrect stock. So I thought I'd use the example of two different stocks here. First one, a great stock to average down, AT&T, ticker symbol T. And the second one I'll talk about is Sears, another stock that you think may be a good stock to average down on, but over the long term, you're going to lose a lot of money. So you got to be very, very selective when utilizing this strategy. So averaging down, as you might imagine, is simply bringing your average cost down. So for example, you can see in the middle here, my average cost is $37.09. At one point, I had bought some shares at $39. It's currently trading at $36. If we go down to my orders here, you can see I've been averaging down this stock for quite some time. You can see a very large purchase here on the 18th, 100 shares at $35.99, which is below my average. So that's bringing my average cost down. You can see another market buy here back in June, $37.77. Another market buy in May. Excuse me, these are all limit buys, $38.62. But you can see here that I've been buying at a cheaper and cheaper price. Here's 5 at $39.57. So all of those buys have been bringing my average cost down. And this is a great way that over the long term, you'll get better capital gains as you bring that average cost down. Once the stock starts rebounding, you'll make your money back. But if the stock is going to bankruptcy, it'll never trend back up. So you lose a lot of money. So you got to be very, very selective and utilizing this strategy. I would only do this for stocks that I have in a buy and hold strategy that I think are very good long-term plays. By long-term, 5 years, 10 years, 15 years down the road. I would not be picking stocks in the penny stock category or even new up-and-coming companies that are still fledgling and could maybe take a turn for the worse and lose a lot of market price. You lose a lot of money averaging down on those types of stocks. So blue chip stocks, market leaders, segment leaders, these are the only companies that I would average down. And I would only average down buy and hold stocks. These aren't stocks you're looking to get out of anytime soon. You want to hold these for the longer term. You can see here AT&T as an example here. You can see a lot of up and down within the price of the stock. And the whole idea behind averaging down is, for example, over the last 3 months, it's down 9.55%. Kind of like dollar cost averaging. You're simply buying shares as the price of the stock decreases, bringing down your average cost with the hope that when it rebounds, you'll make a lot more money in capital gains. Some viewers have asked when I've commented on this in the comment threads, why not simply sell your stock and buy back at a lower price? Well, you never know exactly how low this is going to go. For example, on each of these inflection points here, the stock could start trending back up. And if we go to the 1 year graph, you can see here, maybe at this point here, you're going to sell your stock off because you think it's going to drop all the way down to 36. But you can see here, it drops, but then it starts trending back up here. And this trend is a very long trend, November to January. So this is a very long trend up here. So you would have potentially lost a lot of money because if you sell at any of these price points in here, 37 to 35, you're not going to be buying back when it's above that price. And you can never predict that. It's fairly obvious from this graph here. Yes, it's dropped 9.55%. But again, you can't really predict that over the long term. So yes, you could have sold here, then bought back here. Would have been a very good trade. But you're basically gambling or suspecting that this stock is going to drop. If it doesn't, you've lost some money. So to get away, or a way around that is simply doing some dollar cost averaging, which is averaging down. It's the same principle. I mean, it's really just averaging your cost down by dollar cost averaging is really what we're doing. So we're not trying to time the market. We're not trying to predict the price movement of a stock. If it trends down, you buy more shares of it because it's lowering your average cost. It's very, very simple to understand. I hope I didn't make that too complicated. Simply buying a stock as it's trending down. But you only want to do this for a good company. If we take a look at another company that's lost a lot of market share, you see this is not a very good strategy. So if we take a look at SHLD here, Sears, over the last 1 year, down 36.49%. Over the last 5 years, down 82.13%. So we could average the cost down, again, by just doing dollar cost averaging, buying at a regular interval. Sometimes when there's a big, steep decline in the price, you can buy some more shares than you would if it trends up a bit. But you're really averaging all the way down here. But this is a dying company. This is a company that's never going to recover. It's basically kind of like a company that is on its last few momentum trades. There's really nothing that's going to bring the stock price up other than some pump and dump momentum trading that typically happens with penny stocks. So not a great stock to average down. So you got to know a lot about the stock you're averaging down. Like I said, if you stick with blue chip companies, market leaders in their particular market segment, it's fairly straightforward in averaging down. For example, in my particular portfolio, Pfizer I would average down, and I have been averaging down. Abbott Laboratories, AbbVie, AT&T here. These are all great stocks to average down. I've also been doing a little bit with Intel. This is, I think, a very good long-term play. Price of the stock trends down. It's essentially on sale. You buy more shares of that. That's averaging down. Very simple to understand, but you got to be very selective when doing that. So I hope everybody understands what the intent behind averaging down is. It's really meant for buy and hold stocks that you're going to hold in your portfolio for over maybe 5 years, maybe 10 years, longer term stocks that you want to pick up on the cheap, basically on discount. Average down, and over the long term, your capital gains will be much, much greater when you do sell down the road, maybe 5 years, 10 years, maybe even 20 years down the road. So that's averaging down. I hope that made sense to everybody. I didn't want to make it too complicated. As always, if you guys have anything to add to the discussion, please let me know in the comment threads down below. If I inadvertently said something incorrectly, let me know as well, and I'll definitely correct that in the comment threads. And yeah, kind of with that, I'll end the video. As always, if you guys enjoy my videos, feel free to like, share, and subscribe. Appreciate the support, building the channel almost at 10,000 subscribers, which is absolutely phenomenal. I want to thank you guys for all of that. Make sure you register for the Amazon gift card giveaway. There will be a link in the description below. Just put Robinhood 10,000 as a comment in that video. Like the video, be a subscriber. And when we hit 10,000 subscribers, we're going to do a giveaway video. And it looks like the viewers have chosen to give away more gift cards at a little bit lower dollar amount, but to more people. So I think we'll probably be doing that, trying to give away quite a few gift cards and just have a little bit of fun with it. So again, thank you all for partaking in the video series. And again, if you guys have any good video ideas, let me know. Any good stock strategy, stocks to take a look at. Always reading up about the markets and always looking for new things to not only learn about, but to put videos out so you guys can follow along as well. So yeah, kind of with that, I'll end the video, and we'll see you guys next time.